DeFi, Decentralized Finance. You've probably heard these terms thrown around in crypto conversations. Maybe you've heard people talk about earning interest without banks or trading without exchanges. But what actually is DeFi? How does it work? And why do people think it could revolutionize the entire financial system? In this video, I'll break down DeFi in the simplest way possible, explaining what it is, how it works, and whether it's actually useful or just hype. Let's dive in. DeFi stands for Decentralized Finance. At its core, it's about recreating traditional financial services like lending, borrowing, trading, and earning interest, but without traditional financial institutions. No banks, no brokers, no centralized companies controlling your money. Instead, everything runs on blockchain technology through smart contracts. Think of it like this. Traditional finance is a world of middlemen. You want to save money and earn interest? You need a bank. You want to trade stocks? You need a broker. You want to send money internationally? You need Western Union or a bank wire. Each middleman takes fees, imposes rules, and controls access. DeFi eliminates these middlemen. It lets you interact directly with other people through code that runs automatically on a blockchain. Most DeFi applications run on Ethereum, though other blockchains like Solana and Avalanche also support DeFi. The magic happens through smart contracts, which we discussed in our Ethereum video. These are self-executing agreements written in code. When certain conditions are met, the contract executes automatically. No human intervention needed. No company that can deny your transaction or freeze your account. Just code running exactly as programmed on a public blockchain that anyone can verify. Let's start with the most basic DeFi application, lending and borrowing. In traditional finance, if you want to earn interest on your money, you deposit it in a bank savings account. The bank pays you maybe 1 or 2% annual interest. Meanwhile, the bank lends your money to other people at 5, 10, or 20% interest and keeps the difference. You get scraps. The bank gets rich. DeFi changes this completely. Platforms like Aave and Compound let you lend your cryptocurrency directly to borrowers. You deposit your crypto into a lending pool. Borrowers take loans from that pool and pay interest. That interest goes directly to you, the lender. No bank taking a cut. Interest rates are determined by supply and demand in real time. When lots of people want to borrow, rates go up. When fewer people borrow, rates go down. Everything is transparent and automatic. But here's where it gets interesting. In DeFi, all loans are over-collateralized. This means if you want to borrow $100 worth of crypto, you need to deposit $150 or more as collateral. Why would anyone do this? Several reasons. Tax strategy. You can access cash without selling your crypto and triggering a taxable event. Leverage. Traders borrow to increase their position size. Liquidity. You need cash now but don't want to sell your long-term holdings. The system is designed this way because there's no credit check in DeFi. Anyone in the world can participate. To protect lenders, borrowers must put up more collateral than they borrow. If the value of your collateral drops too much, the smart contract automatically liquidates it to repay lenders. No human decision, no bankruptcy court, just code executing exactly as written. Decentralized exchanges, or DEXs, are another major DeFi category. Traditional crypto exchanges like Coinbase and Binance are centralized. They hold your funds. They control the order books. They can freeze accounts. They can be hacked. We've seen major exchanges collapse and users lose everything. DEXs work differently. The most popular is Uniswap. Instead of an order book with buyers and sellers, Uniswap uses liquidity pools. People deposit pairs of tokens, like Ethereum and a stablecoin, into a pool. When you want to trade, you swap directly with the pool. The price is determined by a mathematical formula based on the ratio of tokens in the pool. You maintain control of your funds the entire time. No account, no verification, no company holding your crypto. Just you, your wallet, and the smart contract. Yield farming and liquidity mining took DeFi mainstream in 2020. Here's how it works. Remember those liquidity pools on DEXs? Providers earn fees every time someone trades. But DeFi platforms wanted to attract more liquidity, so they started giving out their own tokens as rewards. You could deposit crypto, earn trading fees, and get bonus tokens. Some strategies were earning 50, 100, even 1,000% annual returns at the peak. People were making life-changing money, but it was also extremely risky and unsustainable. Many of those high-yield tokens crashed to near zero. People who got in early made fortunes. People who got in late lost everything. This was classic boom and bust cycle. Stablecoins are crucial to DeFi. These are cryptocurrencies designed to maintain a stable value, usually pegged to the US dollar. The most popular are USDC and USDT, which are backed by actual dollars held in bank accounts. DAI is different. It's a decentralized stablecoin created by locking up crypto as collateral. Stablecoins let you stay in the crypto ecosystem without exposure to volatility. You can earn interest on stablecoins, trade with them, and move money globally without crypto price swings. They're the bridge between traditional money and DeFi. So what are the actual benefits of DeFi? Accessibility. Anyone with an internet connection can participate. No bank account required, no credit check, no minimum balance. Billions of people worldwide who are excluded from traditional finance can access DeFi. Transparency. All transactions are recorded on public blockchains. You can verify everything. No hidden face. No cooking the books. No corrupt bankers gambling with your deposits. Efficiency. No middleman means lower fees and faster transactions. Sending money internationally through DeFi can cost pennies and settle in minutes instead of days, and high fees through banks. Control. You hold your own funds. Nobody can freeze your account or deny your transaction. This matters enormously in countries with unstable governments or strict capital controls. But DeFi also has serious risks and limitations. Smart contract bugs. Code can have errors. We've seen DeFi protocols lose hundreds of millions because of a single bug in their smart contract. Once funds are gone, there's usually no way to recover them. Scams are rampant. Anyone can create a DeFi protocol. Many are designed to steal your money. Rug pulls, where developers drain all the funds and disappear, happen regularly. User error is unforgiving. Send crypto to the wrong address? It's gone forever. Lose your private keys? Your funds are permanently inaccessible. No customer service. No bank to call. You are completely responsible for your own security. Regulatory uncertainty is a huge question mark. Governments worldwide are trying to figure out how to regulate DeFi. Some countries might ban it entirely. Some might require DeFi protocols to implement the same rules as traditional finance, which would defeat the whole purpose. We simply don't know how this will play out. Gas fees on Ethereum can make DeFi inaccessible for small amounts. During network congestion, a simple transaction might cost $50 to $100. This prices out most people and contradicts the accessibility promise of DeFi. Let's be honest about DeFi's current state. The Wild West phase of 2020 and 2021, where people were making insane returns, is over. Many protocols failed, many tokens crashed, the easy money is gone. What remains is a more mature ecosystem with real, though modest, use cases. Earning 3 to 8% interest on stablecoins beats most savings accounts. Borrowing against your crypto without selling has legitimate uses. Trading on DEXs offers privacy and control. But you're not getting rich quick in DeFi anymore, and the risks remain very real. The vision of DeFi is compelling. A global financial system that's open to everyone, transparent, efficient, and free from centralized control. No discrimination based on geography, credit history, or wealth. No single point of failure. No corrupt institutions gambling with your money. But the reality today is messier. High technical barriers, confusing user interfaces, constant scams, regulatory threats, scalability issues. For most people, traditional finance still works better, is safer, and is easier to use. DeFi will likely evolve in two directions. One path is full decentralization, remaining permissionless and censorship-resistant even if governments try to ban it. This serves people in countries with oppressive regimes or unstable currencies. The other path is regulated DeFi, where protocols comply with government requirements, implement KYC, and operate more like traditional fintech companies but with blockchain efficiency. This could bring institutional money and mainstream adoption, but sacrifices some of the original vision. Whether DeFi succeeds in revolutionizing finance or remains a niche tool for crypto enthusiasts depends on several factors. Can it scale to handle millions of users without high fees? Can it improve user experience so normal people can use it without a PhD? Can it survive regulatory pressure? Can it eliminate the scams and hacks that plague the space? These questions will be answered over the next decade. If you're curious about trying DeFi, start very small. Use only money you can afford to lose completely. Stick to established protocols with long track records like Aave, uniswap, or compound. Never invest in high-yield farming schemes promising triple-digit returns. Those are almost always scams or unsustainable. Learn how to secure your wallet properly. Understand that you're responsible for your own security. And be very skeptical of anyone promising easy money in DeFi. If it sounds too good to be true, it almost certainly is. DeFi represents a genuinely new way of organizing financial services. Whether it ultimately succeeds in its ambitious goals or remains a speculative playground for risk-tolerant crypto users, we won't know for years. But the experiment is fascinating. The technology is real, and the potential implications for global finance are enormous. If you found this helpful, make sure to subscribe. In the next video, I'll explain altcoins and which ones are worth paying attention to. Thanks for watching, and I'll see you in the next one.